So we are dealing with the paper of April 2025. April 2025, question 4C. So the question says that Matrix Motors Limited is a leading producer of high-quality executive motor cars. The company is developing a new model branded Zillion that is expected to be very advanced. Matrix Motors Limited expects the manufacture of the first car to take 72 assembly hours. It is anticipated there will be a 90% learning curve that will continue until all cars have been produced. Direct labor is paid at the rate of shillings 30,000 per hour. Direct material costs are expected to be shillings 3.75 million per car. This will apply to all 110 cars produced. There are no product-specific fixed costs associated with this new car. Matrix Motors Limited is going to use a target costing approach for the new car model. Based on the market research it has undertaken, Matrix Motors Limited plans to sell each car for shillings 6.4 million. Matrix Motors Limited requires a target profit margin of 25% of the selling price over the life of this new car model. The learning curve index for 90% learning curve is 0.152 negative. Now calculate the value of any cost gap between the target costs of 110 cars and the expected cost of cars. Now the first thing is to know when you hear of the cost gap, cost gap is supposed to be given as the actual costs minus target costs. The actual cost minus target costs. And the target costs is the market price, minus desired profit. Yeah, that is what we do when we are dealing with target costing questions. Now, in our case here, we are told that according to information 6, that the car expects to sell at 6.4 million. So the market price is 6.4. And the desired profit is 25% according to information 7. 25% of this 6,400,000. So, give me the answer on that. So the target, I guess the 1.6 is the profit. So the target price, the target cost is 4 million, 800,000. Now, for you to get the actual costs, you need to work out the figures given here. And you can see they have mentioned learning curves. So using learning curve, I've always told you when you're using this one, there are basic things, 5 of them that you must establish. One is A, the requirement for the first item. The requirement for the first item. So the requirement for the first item, it could be cost, it could be, we normally call it the productivity measure. It could be cost, could be time. Now, the first car, according to information 1, the first car took 72 hours to assemble. So A is 72 hours. Now, the other thing that you must get is R. R, we are told by information 8, it is 90%, 0.9. And when you have gotten that, you should be able to get B as the logarithm of R. You divide by the logarithm of 2. And this one is what the examiner has already given you as the index, minus 0.152. Minus point. Confirm whether that is the answer. Good. Then the third thing or the fourth thing is B plus 1, which is minus 0.152 plus 1. (0.848). Then from there, you must know which formula you're going to use. So we are going to use the formula of the total. So y is given as ax raised power b plus 1. So we need to know y, rather x is what? Information 2 says it is anticipated there will be a 90% that will continue until all 110 cars have been produced. Yeah. So we are doing 110 cars. So X is 110 cars. So if you want to know Y will be 72 times 110, which is raised power 0.848. Ndio tujue the total time. That 876.44 hours. 3876.44 hours. So the actual costs, then should be, if you look at information 3, inasema direct labor is paid 30,000 per hour. So it is 30,000 times 3876.44 plus information 4 says materials will be 3,750,000 per car. So it will be 3,750,000 per car. So times 110 cars. Yeah, they have not mentioned any other cost element. They have not mentioned any other cost element. So they are just two, labor and materials. So 528. 528, 793, 200. Now remember that is all. That is for what? For all the cars. So the cost gap, for all the cars should be the actual, this 528, 793, 200 minus this 4,800,000. Remember this one was for one car and we are dealing with 110 cars. Yeah, so 793,200. Yeah, so that is how you get the cost gap in that. So we close to question 5. Usafi Council has been awarded a street cleaning contract against other competing private firms. The contract price is 6,200 per kilometer of road, and the budget and actual results are as follows. So we are given the budget and the actual. Now reconcile the budget and the actual surpluses. Okay, so that is a profit reconciliation statement. Profit reconciliation statement. We normally have details here. Then we have the formula. We have the workings. And we have the amount. So when you have designed that way, we always begin with budget, profit, budget, profit. And this one is given as budget revenue minus budget costs. Budget revenue minus the budget costs. And as you can see up there, the revenue is 77,500. 77,500. And the total cost is 68,650. And the profit is 88.50. That one is already computed. So they are adjusted for variances. So the first one is sales price. Sales price. Now sales price, you say it is given as budget selling price minus actual selling price, you multiply by actual quantity. Budget selling price minus actual selling price, you multiply by the actual quantity. So sasa, as you can see up there, according to the budget, the cleaning is at 6,200. That's the budget. And the actual down there is still at 6,200. And the actual kilometers done are 11,750. So that one is obviously zero. There was no change. Haya, hiyo ingine tukuje kwa sales volume. Now sales volume, I told you you get it as budget sales units minus actual sales units, or the actual quantity, you multiply by standard contribution margin, or the budget contribution margin. The budget contribution margin. So according to the budget, we were to do 12,500 kilometers. But in reality, we ended up doing 11,750 kilometers. So the standard contribution margin, what you shall do, utachukua naona hizi figure kama za kuchanganya. Nataka kuzirudisha zikuwe full. Wacha ikuwe full. Ongeza 3,000, the three zeros there, so that we don't keep on converting. Hizi zingine unaweza achana tu nazo. Hii iko sawa. Hii iko sawa, haina shida. Lakini sasa hii hiyo ndio tutafanya ikiwa full. So what I want you to do is utaenda pale kuna revenue hiyo ya 77,500, you less 22,400, you less 6,250, and you less 14,400. That's how we get the contribution margin. The selling price, you less those three variable costs: material, labor, and overheads variable. Mesema we are deducting labor, material na variable overheads from the 77,500. Umepata hiyo Maureen?
Yes.
Okay, so the answer is 34,450. Now that one is the total contribution, but it must first of all be divided by the kilometers that were budgeted, 12,500. Ndio tupate how much was per kilometer. Ndio tupate how much was per kilometer. So now once you have divided, multiply the answer by this. Unipatie the final answer. I'm waiting for the answer. $20.67. And that one is adverse. That is adverse because we got fewer kilometers. We did fewer kilometers than what we thought we would do. Higher. Then we come to total material cost. Total materials cost. And this one is given as standard material cost minus actual material cost. Standard material cost, you minus actual material cost. So, according to the budget, the total cost of material was 6,250,000. Now, this one, you are supposed to, first of all, divide by the budget kilometers. Ndio upate per kilometer. Then this one is multiplied by the actual kilometers, 11,750. 11,750. You minus down there, material is 5,800,000. 5,800,000. $5,800,000. So 75,000. Now, if it is positive, that means now this is favorable. It's favorable because inamaanisha the actual ni kidogo. Haya, tukuje nao kwa total labor cost. It is the standard labor cost minus actual labor cost. The standard labor cost minus actual labor cost. And we do the same. Labor, unaona pale juu ni 22,400,000. 22,400,000. You divide this by 12,500 times 11,750 minus the actual labor, which was 21,655,000. Yeah, negative 599. So we normally put it as 599,000 adverse that way. Then tukuje kwa total variable overhead cost. So this one again is given as standard variable overheads minus actual variable overheads. Standard variable overheads minus actual variable overheads. So the standard, ukiangalia hapo juu, it is 14,400 million. According to the budget, 14,400 million. We divide by 12,500 times 11,750 minus the actual here is 13,945. Okay, 41,000 favorable. Then we normally bring fixed overheads expenditure. Now this is given as budget fixed overheads minus actual fixed overheads. Budget fixed overheads minus actual fixed overheads. So the budget was 25,600,000. Minus the actual is 25,100,000.
Excuse me, Mwalimu.
Yes.
The total overhead from my side, I'm getting 409,000 negative.
This one.
Yes.
Oh. Sasa hukuandika nikagoja kidogo kafikiria iko sawa. So you're saying 409?
Yeah.
JM, look at yours. You see, type your figure, Maureen. JM, confirm whether you still maintain 41. Oh, let me then also compute. So it is 14,400,000. First of all, you divide by 12,500. Then you multiply by 11,750. You subtract 13,945,000. 409 JM. I'm also getting 409 negative. So check how you're going about it. Maybe there's something you're missing. Yeah. 409. So that is adverse. Good. We're in agreement. That is good. Now give me this one. This is straightforward. It's 500,000. And this one is favorable. It's favorable because we spent less. Sasa nilikwambia hii format inakuanga hivyo, haitawahi badilika. The only other thing that we normally bring ni volume for the overheads, but that one you only bring it if the question has stocks. Kama umeambiwa kuna opening stock ama closing stocks. Lakini kama hakuna inaishia hapo. So that sasa ukifika hapa unakibia unasema this is actual profit. Actual profit. So actual profit will be actual revenue minus actual cost. Actual revenue minus actual cost. So this will be 72,850 minus 66,500, which is already computed as 6,350,000. So that should be the end of the statement. That should be the end of the statement. And I told you how to reconcile, How to reconcile you get the budget profit, you add the favorables, you less the adverse, it should give you the actual profit. You take the budget profit. If the variance is favorable, you add. If the variance is adverse, you less. When you do so, tell me whether it reconciles. It's going to 53.50. What about Maureen?
Network kidogo inanisumbua mwalimu. Hebu pardon kidogo, umesemaje?
You take this profit, the budget profit, you add the favorables, you less the adverse. I can also confirm.
Okay.
850 minus 2067 plus 75 minus 599 minus 409 plus 500. Where JM? Look again at your workings. Yes, good. So it reconciles. So that is how it's supposed to be done. And I told you hii maswali ya variances inakuanga almost guaranteed itakuwa. I was actually surprised that the paper ya August haikuwa na swali ya variance. For many years, variances have never missed. So in case you get it, hakikisha umeandika mpaka formula. Kisha umeandika mpaka formula. I remember when we were marking this paper, at least there was, I participated in this one. We were just awarding the formulas. Just awarding the formulas. Because very few students were able to panga like this. Yes, that's the format. Hii unaweza ipiga picha uweke kwa kichwa hivyo. That's the format. The only thing that you can change in the exam is only these figures. It's only those figures. But hii format inakuanga hivyo. Yeah. Inakuanga hivyo. The other thing nimesema ni inaitwa nini? The fixed overheads volume. Kama swali iko na stocks, iko na closing na opening, sasa you compute the fixed overhead volume variance. And the other thing that I said is if you're not very sure, you can avoid these labels. You can avoid the labels. Uziache tu figure hivyo. Weke hii na hii. Na kwanza hizi usiache because this one most likely will be given. Yeah. Okay. But I'm not teaching you not to be sure because I'm not only teaching you for the exam. You become consultants. You need to advise the client conclusively. Let's go to part B. The board of directors of Roadways Coaches Limited is considering two mutually exclusive models of buses to purchase for its booming business: diesel-driven bus and electric-driven bus. Both bus models necessitate buying new buses, and both buses are expected to have a useful life of 5 years. Now, diesel-driven bus model, this model has already been appraised. Details are initial investment 4.5, average return on investment 12.5. Electric-driven bus model, we have revenue, or rather expected revenue and operating costs of electric-driven bus model are, we have the year, the revenue per year, operating expenses, depreciation. Initial additional information is that the initial cost of purchase of the electric is 5.5. Depreciation is calculated on a straight-line basis of useful life of the asset of 5 years. Both buses have no salvage values. When computing the financial measures, the company uses profits only and not cash flows. In calculating divisional return on investment, divisional written down values are valued at net book values at the beginning of each year. Operating expenses and depreciation expenses are written off in the determination of annual profits. The expected values are in present values. Ignore inflation and tax. Now, evaluate the average return on investment on the electric-driven bus. Yeah, so hii ni swali ingine niliwaambia, hii maneno ya return on investment and residual income, it is also a very, very good ground for the examiner. The probability that your paper will miss a question on that is very low. The examiner anapenda hii sana. So sasa hii performance measurement. For the electric bus. For the electric bus. So mine I'm drawing because my book is not ruled, but yours is ruled. You don't have to draw these lines. So hapa tuko na details. Na huwa tunaanza na opening net book value. net book value, which we normally call A. It is the one that the examiner here is referring to as written down value. Written down value is also the other word for net book value. Then we bring the depreciation. Now depreciation, we normally designate it as B. Then we have the closing net book value, which will be given as A minus B. If they are charging cost of capital, okay, they have not mentioned cost of capital. Yeah, so they have not mentioned the cost of capital. So that means we shall not compute the residual income. But kama ingekuwa imetajwa, tungeiweka hapa. So let's now bring the revenue. The revenue. Now this one we can call it C. We bring operating expenses. Operating expenses. And we call them D. Now this depreciation, let's confirm whether it is the one that we should get. The one that we are going to compute here, it will be given as 55 according to information 1. That is the initial cost, and the asset is useful for 5 years. So confirm whether this is the one. 5,500 divided by 5. Is it the one? Yeah, so if it is the one, we shall not bring it again because we already have featured it. So with that, we are just going now to talk of the income. So our income should be given as the revenue minus these operating expenses minus this depreciation. And we can call it E. That is how we shall get it. Sioni kama kuna anything else. Because now we don't have the cost of capital, we will not be able to get the residual income. Sasa with that now we just go straight and get return on investments. Return on investment. Return on investment. And the return on investment will be given as E. You divide by A. You multiply this by 100. And this one is what they are saying. Unaona information 4. That is the one that is explaining this formula. It's the one that is explaining this formula. So sasa ikiwa namna hiyo, mimi nimekuja hapa nitafute mwisho. So we have here 1, 2, 3, 4, 5. Those are the years. So with that now, tuende kwa the opening book values. We can have our figures shillings in thousands. And the opening book value is, oh, have you finished drawing? Let me get to know. If you are finished, say my yes. If you are finished, say my yes. Okay. So sasa tukitoa depreciation hapa, niambie tuking'oa hii depreciation, closing na baki ngapi? $4,400. Then 4,400 tutoe hii 1,100, tabaki na 3,300. Tung'oe this one, we are left with 22. Yeah, that way. Revenue, that 900, 4,900, 5,400, 5,350, 5,950. Operating expenses, that's 200, that is 700, that 900, 41 and 4,200, 4,250. So sasa ukifika hapo unipatie income ya the first year. Negative 400. Haya, next. Maureen, give viewers. Supposed to be 4,900 minus 3,700 minus 1,100. 100. Oh, nafanya vibaya. Haya, tuende kwa hiyo ingine. 5400 minus 3900 minus 1100. $400. Haya, hiyo ingine 5350 minus 4100 minus 1100. Is 150. Next is 5950 minus 4250 minus 1100. Yeah, 600. So let's get the return on investments. Return on investment. Negative 7.27%. The next. $25%. 25%. This 1100 divided by this 4400. JM, hope you have gotten that. Next is 400. You divide by that 300 times 100. Yeah, 12.12%. Next is 150. You divide by 2200. So which one is not correct? This one. Oh, by the way, that profit was not correct, because it was supposed to be 4,900. You minus this, that is 700. You minus 1100. Oh, this was 100. Okay. So if it is 100, we divide by 4400. Oh, so this is the one. Yes, thank you, JM. 2.27%. Good, 2.27%. Haya, songe kwa the next 150 divided by 2200. Maureen, check yours. I'm having 6.82. Yeah. You've confirmed that, Maureen? Good. Next is 600. You divide by 1100. $54.55. So the average return on investment. So the average return on investment should be negative 7.27 plus 2.27 plus 12.12 plus 6.82 plus 54.55. Now this one, you divide it by 5. You divide it by 5. Yeah, 13.698%. Something around there. Well, Maureen. This one is negative, this one. Maybe that's the one you have not put as negative. Have you corrected that, Maureen?
Yes.
Okay. So now the question is telling us to advise on which model to purchase. So the advice, do you advise them based on, rather, you advise them to go for electric or the diesel? What do you advise that company to do? Yeah, they should go for the electric since it has a higher, so purchase electric bus since it has a higher ROI. That is 13.698% is greater than ile ya diesel kwa tumeambiwa ni 12.5%. 12.5%. So that is the advice that we should give them in that regard. Haya, tukimbie nao kwa December 2024. December 2024. December 2024. Question 1 is asking, discuss 4 benefits of using rolling budgets in an organization. Rolling budgets. Now we discussed this. We discussed this in our notes. And just to remind you, we said what happens if this is January, then you have February here, March, all the way to December here, all the way to December, or I can put December here. Now, what happens? You prepare a budget for the whole year. For the whole year. Then you start implementing it on 1st of January. You run with it until the end of January. You stop. When you stop, you compare what you budgeted vis-a-vis the actual that was realized. And when you compare, as you know, this gives you the variance. Now, this variance will tell you whether you over-budgeted or you under-budgeted, either advanced or favorable. Whatever information you get, you readjust your figures. You readjust so that on 1st of February, you are now running with adjusted figures. And after you have adjusted, you add 1 more month here. So by the time you are starting to implement the readjusted budget on 1st of February, it is still stretching forward 12 months. Again, you run with the budget throughout February as you record your actuals. End of February, you stop. Compare what was budgeted with the actual, get the variance, know whether you over or under budgeted. Then 1st of March, you readjust. Then you now get a 1 month here. So that's why it's called rolling. That's why it's called a rolling budget. So we covered that. And now to respond to what the examiner has asked. Number 1, Adika, increased flexibility. Number 1, the advantages, increased flexibility. There is increased flexibility. Increased flexibility. Another one is improved decision making. Improved decision making. Improved decision making. Number 3, proactive and more practical. Proactive and more practical. Yeah, proactive, tunaitengeneza mapema. Practical, we also consider the reality. Proactive and more practical. Another one is easy identification of issues. Easy identification of issues. Easy identification of issues. Another one is improved cash flow management. Improved cash flow management. Improved cash flow management, improved cash flow management. Yeah, so those are some of the advantages that you get when you use the rolling budget. Good. Part B. The management of Mario Processing Company Limited wishes to obtain a better cost estimate to evaluate the company's operations more effectively. The following information is provided to you for analysis. So we have the year, the equivalent production units, the overheads. Now, using high-row method, estimate the cost function. High-row method. Now, using high-row method, we start with the format. The format, you know, is y is equals to a plus bx. Then we substitutions. We substitute. What you do, unaenda hapo kwa units, you pick the highest. The highest of them is which one? When you look at those units, the highest. The highest of those units. Yeah, is 1690. And the cost of that is 15,280. 15,280. So 15,280 is equals to A plus 1690B. And this is the highest. And I told you that this 15,280, it can happen to be the highest among the costs, but sio lazima. It need not be the highest. Yeah, it need not be. And if it was not, we would still have taken it, because in the costs, we do not go to select. We already select in the units. And then tukishajua the highest number of units, tunachukua cost yake, whether ndio the highest ama not the highest. Tukishachukua the lowest units, tunachukua the cost yake, whether ndio the lowest or not the lowest. So it's good to take note of that. Higher. The lowest number of units, $834. And the cost of the 834 is $91.50. And something else that you need to note is the examiner also can trick you by making the figures to be different. One column iko kwa thousands, the other one is not in thousands. So you should always work with figures that are similar. So kama moja iko kwa thousands, you make the other one to be in thousands, ama you utoe. Or both of them to remain in thousands, like sasa hizi. Yeah, so that is the other trick that we can use with these very simple things. Haya, sasa, you subtract. 15 minus 9, we get what? 6130. Haya, 1690 minus 834. $856B. So B should then be 6130. You divide by 856. $71. 7.16. 7.161. And it's good to remember, this is now the variable cost per unit. This is the variable cost per unit. The variable cost per unit. Alright. Then you come here and say 15,280 is equals to A plus 1690 times 7.161. So based on that, that 177.91. Now this is the fixed costs. So the equation then will be y is equals to that 177.91 plus 7.161x. And remember, this equation is in thousands. Yeah, the figures were in thousands. The next one is regression. Simple regression analysis method. Simple regression analysis method. Remember, ndio bado inaitangwa ordinary. So the format is y is equals to a plus bx, where b is given as n, sum of xy minus sum of x, sum of y. You divide by n, sum of x square minus sum of x, you square. Kawaida huwa tunachora tables Kawaida huwa tunachora ile table iko na 4 columns, but si lazima uchore table. Like now sasa hii for the interest of time sitaki tuchore table. Nataka tutafute hizi values straight in the calc. So let's go together. You just put the figures in the calc. 1425 times 12,185 plus 950 times 9875 plus 1130 times 10,450 plus 1690 times 15,280 plus 1006 times 9915. Kwanza unaweza sema equals ndio isianze kurukaruka, although these are not very high figures. Equals plus 834 times 9150 plus 982 times 10,133 plus 1259 times 11,981 plus 1385 times 12,045 plus 1420 times 13,180 plus 1125 times 11,910 plus 980 times 10,431. Na yangu imeanza kurukaruka, so acha nitoe hii ya mwisho. Equals plus 980 times 10,431. So tell me whether you get these values are 12. So it is 12 times 166,035 905. Tell me whether you have gotten that figure. Have you gotten that? Or you have a different value? Can see JM saying a different one. Are you worried? When I revise, I get the same.
Marimo, I'm getting the same as you.
Okay. JM, Wechoka. Let me give you the answers because I have used the calc. You will go and confirm. Ndio tukue hiyo swali tumemaliza. Sum of x. If you get the sum of x, it is 14,186. 14,186. Nishaweka zangu kwa calc, so this one must be very accurate. 136,535. Higher. So this is 12. Just copy, you will confirm. Sum of x square is 17,483. 772 minus 14,186 square. And the answer that you shall get for B, you should get something to do with 6.486920899. Higher. A is given as sum of y minus B sum of x. You divide by n. So sum of y is 136,535 minus 6.49 times 14,186. You divide by 12. You divide by 12. $3,709.295011. So here's your function. So the function y is equals to 3709.295011 plus 6.49x. So sasa hiyo you will confirm and then you interpret R square so that God willing we can pick up from there tomorrow. We can pick up from there tomorrow. Thank you. Nice evening.